Well, we have seen some good gains in the Asian markets as well.
The 20-day moving average is 21,425.
The wholesales in Q3 were very strong from JLR.
I think we are pretty good on meeting our targets in terms of sales.
First tick on the index, very strong, up 130 points.
Margins are fine, I think, for IT sector. They're normalized after the pre-COVID levels.
So essentially about 4 million shares that we are looking to mop up as part of this buyback.
Sony is planning to call off this proposed $10 billion merger.
The slowdown in global economy is required because that's what's going to keep disinflation on this disinflationary trend.
Rate availability has been about 11% higher compared to last year.
The market has rebounded quite smartly from yesterday's low, and it's retaining a bulk of that gain, at least as of now.
Today, let's say we can go up to 90% utilization in next 2 years' time.
We have an amazing joint venture with Tata's. These are people from the community that we're working with.
Banking index was one which was underperforming yesterday, so it has come back with a bang. Nifty IT, Nifty Realty continue to do well.
Well, that was a day so far. We are coming to you live from the CNBC-TV18 News studios in a fresh new edition of Closing Bell. I'm Prashant. With me, my colleagues Rima and Surabhi right here in the studios. And Nigel is joining in from the newsroom floor. Guys, hi, good afternoon. We're starting on a bit of a somber note, right, guys?
Yeah.
As we start, I think the Nifty from being up almost at 1.200 points is only got about 60-odd points remaining.
So it's a very sudden and very sharp fall. Bank Nifty already
Nifty
down
Bank is
130. So it's
in the red now.
Yeah, absolutely. I mean, it's a sudden reversal that's come in. And I guess that's telling us about the nature of this market. It's sort of range-bound, yet very choppy and extremely volatile. That's how the last couple of days have played out, Prashant.
I mean, we were at 21,700 at 2 o'clock, and this is 2:30, and we're, we've lost about 130 odd points from that level, not even from the day's highest point. So that's a very, very sharp move, and that's essentially one of the points we were making in the morning. The start in the morning before markets opened, GIFT Nifty was indicating 125 points higher start. There was no trade back then, although you could have, theoretically you can argue and say that we started 125 and added on a little bit more, and that would be true. But the point is that, it's more wait and watch. It's still range bound and, it's still up and down. If we were up 200 points right now, I mean, that also would have been kind of crazy. 200 down yesterday, 200 up today. So in a way, this is more like it. That's the texture of the market the momentum, the up and up kind of daily moves that kind of ended, I think, last week or so. And January is more volatile and it's generally a little more subdued as compared to the last 2 months, which have been fantastic. So that's where we're at. I'll just put out two levels before we go any further. So we basically, by the way, the day's highest point came within 40 points of yesterday's high. As I said in the morning, only above yesterday's high, which is 21,763, could you kind of, that would be the negation level. If we stay above it, we close above it. Of course, now there is greater distance. Then you would say that maybe things are looking good, which is not the case. Bank Nifty is also off the day's high. It's now, of course, firmly, with it being negative now, it's firmly under the 20-day moving average. It closed under the 20-day moving average yesterday. And there, the negation level is 48,382, similar to what we saw on the Nifty. So lots to track. Real estate, the last I checked was doing better, outperforming the rest of the indices. Metals and autos were some of the others, which were doing a little better relative to what's happening in the rest of the market. But there's a lot happening, and we'll continue to track that here over the last 1 hour or so. Rima.
Well, it's a sudden reversal. And just pull up the intraday of some of these financial stocks, which is where the losses are emanating from. Axis Bank, Kotak Mahindra Bank, State Bank of India, HDFC Bank, ICICI Bank. It's a very sharp reversal, a last, 10-minute, 15-minute fall in all these names. Today is also the Fin Nifty weekly expiry, so keep your eye on that. Typically, the action plays out in the last 1 hour, but we've started seeing that since 2 o'clock. That's the financial space for you. The Nifty Bank is now in the red. It's down 0.3%, a 125-point fall on the Nifty Bank. And at one point of time, the Nifty Bank was up, close to about 500 points. The mid-caps too have erased all their losses and now are pretty much, flatlining.
Absolutely. On the mid-cap side as well, the fall is quite apparent. And some of the financial names like PFC, for instance, they are the ones that are falling even beyond the index. Aside of that, I'm looking at where the price action is on the way down right now in mid-caps. And you have a few names here and there, RBL Bank, PFC I mentioned earlier, Restaurant Brands Asia. That stock had run up a couple of days back. Now there's some profit taking that's going on. Bank of Maharashtra. So these are some of the names where you are seeing some of the gains come off the table. And then you have the usual suspects. I mean, of course, Zee, though there's been so much drama around the stock and the denial from the company. But anyway, for what it's worth, Zee is still down about 6.5%. However, you have some gainers as well on the upside. NBCC, GMDC, a stock that Nigel has been telling us about. They've got some environmental clearances for important mines. So news has kept those stocks afloat. But otherwise, Nigel, what a topsy-turvy afternoon. And we still have a good 55 odd minutes left.
Well, that's right. Let's see what the Nifty Financial Services Index wants to do, right? And as we've been mentioning, the Nifty Bank, that's the one that holds all the cards. When it does well, we see the markets were up and about. Today, in fact, it's quite disappointing because at one point of time, it went past the 20 DMA. If we pull up the intraday chart, we plot the 20 DMA of the Nifty Bank as well. You'll see intraday we went above that level. And from there, we have corrected closer around 500 points. So that's a bit of a disappointment because you had the feeling that the Nifty Bank wanted to build on to those gains. So let's see how this goes. But the breadth of the market, still more stocks advancing than declining. So you like that. How do you trade, though, from here on? Mitesh Thakkar joins us. Hi, Mitesh. Morning. I think earlier this morning you were hinting, don't chase the gap up. And if you didn't do that, you'll be quite happy. But we're still up close to around 90 points approximately, 21,600. What's the call from here on?
I think, we actually were looking at the fact that this will be a market which will still be ranged. And therefore, you will see supply emerge at higher pivots. And I think 21,750, 21,820 were the two levels which I was watching. And we got a high of around 21,725. So it's still a market which is ranged. I think, not much happening on the trend side. And therefore, I think chasing gaps is not an idea. We suggested buying on declines. And I think now, again, we are focusing on the pivot of 21,500. I think around that is the area to buy with a 55 point odd kind of a stop loss. And that's the way it should be. On the stock side, Hero Motors is something which is showing good traction on the short-term chart. So buy here with a stop at about 40.55 or maybe 5 points below that 40.50 is what I recommend. And a target of around 42.25 can be looked at on the upside. And on the other side, I think Colgate, after a good rally, good run in the last few weeks, is coming under pressure. First signs of profit booking taking place over here. So that's a sell for a target of around 23.75, and I would recommend a stop place around 24.70.
Okay, got that. Mitesh, thank you for the calls. We'll come back to you after half an hour. See what the shape of the market is at that point in time. Let's focus on some of the stocks that are hitting the headlines today. As we just mentioned, Zee has been quite the story. Now it's nearly 24 hours. First, there was some agency reports suggesting that the deal is off, the deal with Sony, the merger. The company came out and issued a denial not too long ago. We have Hormaz joining in with all the drama. Never a dull moment here, Hormaz.
It never is, isn't it? Whenever Zee is involved, there is never a dull moment. And this back and forth between the two companies has been on since the merger the deal was signed in 2021. But just as you said, just a few minutes earlier, Zee Entertainment came out with a clarification on these reports, saying that the Bloomberg report of Sony's plan to terminate the merger is baseless and factually incorrect, and that the company is committed to complete the merger with Sony, and they are continuing to work towards a successful closure of the proposed merger. Now, earlier this morning, the stock fell as much as 12-13% in intraday trading, and that was on the back of this Bloomberg report which came last evening, which said that Sony is planning to pull the plug on this $10 billion merger. Now, what is the reason this time around for the latest standoff is that Sony does not want Puneet Goenka to become the CEO of the merged entity, and Bloomberg has reported this citing sources, and CNBC-TV18 did not have independent confirmation of this report. Now, as a result of which, if you can recollect, in August of last year, SEBI had barred both Subhash Chandra and Puneet Goenka to from holding any key managerial positions in Zee Entertainment. And this decision of SEBI was overturned by the Securities Appellate Tribunal or the SAT, as a result of which Puneet Goenka was reinstated as the MD and CEO of Zee in October of last year. But nonetheless, the stock, after this clarification came out, the stock briefly recovered from the day's low. It's still down around 7.5%. It's in the F&O band today, and the earlier fall that it saw took its market capitalization below 25,000 crore rupees. Back to you.
Okay, thank you very much for that. This drama over the last 12 months has hurt Zee Entertainment. In the last 1 year, Zee Entertainment is up 9%, versus a 50 to 55% gain for other media companies, whether it's TV18 Broadcast, Network 18, or even a Sun TV has seen a 51% rally in the last 1 year. Dipan, with so much volatility in news flow and lack of certainty, is this stock a complete avoid? And if someone has existing positions in Zee Entertainment, what should they do?
Yeah, good afternoon, and thank you for having me on your show. You start with a tough one, because if you're holding Z shares, then you're going to have a few such nervous moments because it's a highly volatile stock. And no doubt the prospects post-merger look very interesting. It'll be the largest media company and many profit centers and so many channels. So to an extent, the business will get de-risked. And mind you, advertising spends are going up, subscriptions are going up, and they also have the OTT offerings. So on a fundamental basis, it's an attractive business proposition. But there's just far too uncertainty around this merger. And I don't know the final outcome, the equity, the ownership, the management, all of those remain unanswered. So at least I'm not buying into these corrections. But the time to sell also is gone because valuations are attractive. So I think you just stay put. At least don't put fresh money into Z at this point of time.
Well, if you've seen it through all this over the last 2 years, you might as well wait to see how this, ends. So according to Dipan, this is not the right time to buy or sell. If you are invested, just stay put. But let's now move across to IRB Infrastructure. That's the next stock on our radar, and it's fired up as toll collections have jumped 25%. Vivek is here with the details.
Well, absolutely right. So IRB Infra, what's actually happened is that when you're talking about the toll collections, last 3 to 4 months especially, it's been on a very sharp upward rising trend. This has been aided by a couple of factors. First factor has been the fact that the company was allowed to take price hike across a few of the toll roads that they actually operate. Along with that, traffic volume has increased quite substantially. And number 3, they've also gone ahead and onboarded a few projects where they've started collecting toll, which has also come into the figure collections that you're looking at. So looking at all of these, keeping in mind the context of the above 3 factors, have a look at the collections. December toll collections have come in at 488 crore versus 388 crore on a year-on-year basis, up 26% on a year-on-year basis. IRB InvIT toll collections has come in at 90.2 crore versus 77.5 crore, again up 16.5% on a year-on-year basis. So very strong toll collection continues for IRB Infra. The stock has been a significant outperformer, especially of late.
Okay, all right. That's IRB Infra in the limelight today. Thank you very much, Vivek, for joining in. So some stocks that are catching the limelight. Dipan is, of course, with us. Good afternoon, Dipan. IRB Infra, any interest in this one?
See, I think it's been a bit of a laggard compared to some of the other infrastructure companies. And largely, it is a road construction company. And large part of the revenues come from toll collections. So from that point of view, we would prefer companies which are actually just doing engineering construction. And there are more interesting names like, say, ITD Cementation comes to mind. And if you want to be risk averse, then something like Larsen & Toubro also still may have provide outperformance going forward. But this stock certainly, I think, on a valuation basis, especially on a breakdown basis, is at attractive valuations. But I would say that there are better plays in the infrastructure space.
Okay, all right. Hi, Dipan. Good afternoon. I recall us discussing ITD Cementation, and boy, that didn't do well, right? The management, we had that interview here with CNBC-TV18, we visited their office, and it seems they walked the talk out there. But let's focus on one big loser today. That's Polycab, a rank outperformer, gaining market share, managing their margins, talking about doing 20,000 crores of revenues. But today, it seems the street is a little bit nervous, on reports of taxes, on reports of, some kind of faults with regard to the books as well. The management has come out and clarified that everything is erroneous and they believe that everything is clear. What would you do? Stock 8% down, buy into it, or wait for further clarity?
See, per se, Nigel, I'm not that great a fan of Polycab. And that's because it's a pure and simple cable company. They're trying to get into other electrical products, but that entire endeavor has not been that successful. They're trying to go the Havells way, but not really anywhere close to that. So I'd just like to wait and watch. If you want to buy something in that kind of a business, then I think Apar Industries is far better. They have a nice global operation. They're into conductor business, transformer oils, as well as cables, all of which are firing on all cylinders. And the fact that they are diversified globally is an added benefit, and it does de-risk the business model. valuations-wise, I think they're pretty much comparable, upon maybe slightly cheaper as well. So I'd like to go with that. And I think Havells also, I think on a business-to-business basis, and the kind of brands which Havells has got, and the track record, I would prefer that company over Polycab, which is still largely a cable company, which is still a B2B business. So, I would not like to pay such a high premium for that kind of a business entity.
Got that. Anything on do you own JSW Energy, Deepan? I mean, stock's up some 8% today. I'm not sure there's some specific news flow, but there's a big move.
No, Prashant, we don't have any interest in JSW as a measure of energy, as a measure of disclosure. But, all these private sector power companies, they are really going from strength to strength. And JSW Energy has a very ambitious expansion plan, more and more into renewables than ever before. And there are great M&A opportunities as well. I think the entire power generation sector has got a high degree of earning visibility and I would say regulatory stability, which is driving investments and keeping a lot of investors interested in it. And power demand, mind you, with rising GDP is certainly going up because of high urbanization and industrialization as well. So positive on JSW Energy per se, don't go by the past track record. I think a lot of plants are going on stream. And I suspect in a 2 to 3 year time frame, the company will be double its size in terms of power capacity, notwithstanding any M&A activity which may come through.
Dipan, do stay on. By the way, the fall on the Nifty Bank has just gotten a little worse. At 2:30, when we started the show, the Nifty Bank was down about 130, 140 points. And now it's about a 200-point fall on the Nifty Bank. The Nifty is hovering around 21,550. So it's trying to find its feet around these levels of 21,550. Let's see whether it can hold. Get into a break. We'll come back, continue our conversation with Dipan. On the other side, we'll also be joined by Rajesh Kothari of Alf Accurate Advisors. Welcome back. The Nifty's recovered about 20 points from the lows, went down to 21,550, now at 21,575. You can't see it with that big fall that we've had in the last 1 hour, but markets have stabilized now. They've stopped falling. Divi's Laboratory has seen a sudden spike in the stock. It's up close to about 1.25%. Dipan, another stock I wanted to get your view is on Yatra, the online travel aggregator. Now, it listed in the month of September. The issue price was 142. And the stock, 4 months down the line, is at 164. A mere 15% rally. And this is in the travel space, a segment which has, which is seeing some bumper numbers, very strong interest by investors. But Yatra seems to be given a bit of a pass. Have you looked at Yatra and the financials or any thoughts on the numbers?
No, Reema, I haven't looked at Yatra that closely, and that's because it's a highly competitive space, and you want a business which is doing something innovative. So like RateGain Technologies, something which is quite an innovative play on the travel space, but again, very expensive, would like to buy at correction. And when you want to buy into travel, I think I just can't get beyond Interglobe Aviation. Disclosure, we and our clients are invested in it. I do feel that, Indigo, the way it is going, the kind of market share it has got, and the number of new planes it will add over the next year or so make it really attractive. And oil prices, of course, have corrected, and number of flights are increasing. The occupancy levels are great. From all points of view, I think they're entering into a great phase in terms of growth, and valuations also are reasonable. I think profits will surprise on the upside. So when I'm looking at the travel space, I prefer Interglobe Aviation over any other stock at this point of time.
Okay, that's about the travel segment and your preferred picks there. Now, Bajaj Auto is also one of the stocks on our radar. The board yesterday approved a 4,000 crore rupee buyback at a price of 10,000 rupees per share, a big 40% premium to yesterday's closing price. We chatted with Dinesh Thapar, the CFO of Bajaj Auto, to understand what went behind this buyback math of a 10,000 crore price and the size of 4,000 crore rupees. Listen in.
Essentially about 4 million shares that we are looking to mop up as part of this buyback. It's about 16% of our paid-up share capital and free reserves, and therefore this is subject to shareholder approval, and we'll run through that process between now and the middle of February. We reflected on this and had an extensive discussion at the board, was to really use this as an opportunity to reflect on our performance over this last little while, which has really been quite compelling and really outperforming in terms of the broader industry. Will not end up diluting because we think, with the current pricing that we've put out, it presents a very compelling proposition for investors and shareholders to really make their full entitlement. And therefore, if that was to be the case, the promoters will tender in line with their entitlement. To that extent, I expect post-buyback shareholding for them not to be diluted. In fact, it might creep up slightly because we've also got a 15% reservation for small shareholders over here. So when you do the maths on a post-buyback percentage, the promoter holding, assuming everyone tenders in line with their entitlement, should be at about the same levels or a tad higher.
Okay, that is Bajaj Auto. Well, it's a sweet dilemma that investors are in, Deepan, on this one. I mean, if you're holding the stock, you've been riding high on this 50% rally over the past 1 year. You have a buyback at 10,000 rupees, but then you have prospects of the company continuing to do well, given how confident they're sounding. What would you do here?
No, I think the stock has rallied significantly, and buying at these levels, even for a buyback arbitrage, doesn't really make sense. I think wait for a correction. Within the two-wheeler space, I thought even TVS Motors and Eicher Motors also will play catch-up with Bajaj Auto when the numbers are perhaps declared. So by and large, if you're a shareholder, just enjoy the ride up and remain invested, but I wouldn't want to buy at these levels.
Okay, all right. Deepan, what about a couple of these other names that we're looking at? In today's trading session itself, you have Vodafone Idea that's down closer around 5% approximately. What's the view out there? Will you look at it? I mean, there is hope that maybe, in fact, something's got to give. And if it survives, will you look at Indus Towers? That's the alternate way of playing it.
Yeah, well, I think Indus Towers, first disclosure, we and our clients are invested, and that's a more interesting opportunity than Vodafone. And no doubt, I think if Vodafone does get into a situation, then Indus Towers also will get certainly impacted, but I think to a lesser extent. And right now, I think, unless there is some finality on Vodafone's future in terms of fundraising, and once its survival is ensured, only then one could look at both these companies on a fundamental basis. Right now, the uncertainty is just too high. And mind you, the fundraising from Vodafone has been getting delayed by many quarters, and this is the best possible time for them to do a fundraise. And if they miss this bus, then I think it's going to be very difficult for the Vodafone to service its debt. So I'd be a bit cautious in both Vodafone as well as Indus Towers. And on a side note, I think Indus Towers is now trading at a slight premium to the recent M&A deal which took place for ATC, which was bought by a private equity. I think it was BlackRock. I'm not completely sure. So from a valuation perspective, also I think Indus Towers is fairly valued.
All right, Deepan, we'll leave it there. Best time for everyone to raise money, right? I mean, there's demand exceeds supply, so why not? And I think companies are taking full advantage of sort of coming to the market, and the momentum is going to be as strong, if not stronger, if markets stay as good. Thanks very much once again, Deepan, for joining us. Rajesh Kothari is now joining us from Alpha Accurate Advisors. Rajesh, good afternoon. Good to have you here. Thanks very much for your time. I just want to start with Sabe asking about banking, where in terms of what, to your mind, the margin seems to be the issue with banks, because it's well advertised, the strengths and valuations, perhaps the only large sector where valuations are not out of whack. But stocks just refuse to perform. Over ownership may be one, but that also has been pretty well discussed. Everyone knows about it. And still, majority of the funds, PMSs, etc., are overweight the sector. So just your thoughts there.
Well, I think, fundamentally the things are well in place. The good thing is that the loan book growth is still going to be good double digit. I think that is going to be the key factor. On the net interest margin front, I think Street was always, if you look at last year also, and if you divide the last year in 4 quarters, the estimates kept changing significantly. Earlier, everybody thought that second half 2023 interest will decline and therefore something will happen, but that didn't happen. And then everybody had to upgrade their numbers. So right now people are assuming that net interest margins are going to reduce, and everybody is expecting therefore the NII growth, net interest income growth, is also going to be subdued around say 9 to 12% for the sector in general. So that's basically the underlying assumption. But I think the key question here is first on the loan book growth. If the loan book growth remains solid, the non-food credit growth remains solid, then it is only question of time when you will, once you get the high base over. So I think it is more of a base effect. But important, it is the underlying asset quality, and that remains strong. So I think, yes, right now Street is a little bit, stocks are not performing compared to where the market is. But you know how the markets are, am I right? You always get 1 week out of 52 weeks, which is more than enough to, do the entire outperformance for the full year. And that's how the stocks behave.
Absolutely, Rajesh. And we saw that in 2023, right? I mean, just those 6-7 weeks, November to mid-December, it was absolutely breathtaking. Rajesh, we want to discuss life insurance as a sector with you because there's so much happening out here. Just allow us to look at the monthly data which has come through. So the data for the month of December is out. It seems HDFC Life is lagging its other peers. We have Upasana here with all the details. Upasana, fill us in on the numbers.
Well, life insurance is a sector that remains in focus today as life insurers have reported a healthy growth of numbers for the month of December in terms of AP and premium growth, with SBI Life and Max Life topping the list. Well, SBI Life has recorded a double-digit growth of almost 21% in its premiums on Y-on-Y basis, and AP has also seen a growth of almost 22% on Y-on-Y basis, followed by Max Life, which has shown a premium growth of almost 18% on Y-on-Y basis and AP growth of almost 22% on Y-on-Y basis. Now coming to ICICI Pru Life, it showed a single-digit premium growth of 3% on Y-on-Y basis, and even AP saw an uptick of almost 3% on Y-on-Y basis. Now, HDFC Life also saw premium growth of just about 3% on YoY basis, which remained muted, and AP also saw an uptick of almost 3% on YoY basis. Now, as compared to the private players, LIC reported a good set of numbers with premium uptick of almost 94% on YoY basis, and AP also saw an uptick of almost 23% on YoY basis.
Wow, those are some really breathtaking numbers from LIC. And it's not very often that we have that kind of growth by the public insurer over the private sector names, and HDFC Life lagging the others. That's also an interesting trend in December. But perhaps, year-end factors, holidays, etc. also playing their part. Rajesh, come in on life insurance. If we pull up the chart of any life insurer stock for 1 year, it's very volatile and very, very sort of chaotic because there have been so many regulatory push and pull factors here, right? From taxation at the start of the year, now there's talk about higher surrender charges, etc. How are you positioned on the sector?
We have a zero exposure to this sector as a direct play. We prefer to play it indirectly by holding the large banks who in turn are having stakes in their insurance business, be it life, be it general or even AMC business. And I think that's probably, in our view, that's a better way to, because anyway, insurance is not that huge part of the sum of parts, but we are not that positive in insurance sector because of the lot of regulatory risk and as well as the taxation related risk. Because disparity still continues. There's a lot of what I would say gray areas in terms of the selling of the insurance products, and the regulations are becoming stricter, which will definitely make the growth a little bit slower in our opinion. And therefore, it is better to play through banks rather than direct play on insurance.
Okay, all right. Hi, Rajesh. Good afternoon. Good to speak to you today. Rajesh, how do you play this entire travel leisure space? It's already done well, but it appears Indians are in the mood for it, and maybe, in fact, some of the listed stocks could still do well from here on. What are you all picking? The suitcase maker, as we have only two options, VIP or, in fact, Safari. Safari has done very well. VIP has not done well. Has the time come to bite it? Or will you play some of those hotels, aviation stocks? Your take.
So, Nigel, I think it is an overall consumer play what we are doing rather than just, travel play. So whether it is so if you look at our large holding as far as our budding beast goes, or even for IOP, for example, we own Safari in our budding beast from last 2.5, 3 years. It has been, of course, multi-bagger, stock for us. And then we also own the companies like Trent, which is also one of the best performing stock from last 2.5 to 3 years. So I think it's more of a right companies playing at right time, and very importantly, they keep changing the product portfolio. They remain relevant to the consumer, and that's basically secret. So there is always a debate that why few consumer companies are not doing so well within the retail space, and why one or two companies are doing extremely well, because those companies are more agile and they remain relevant. They keep changing their product. They are innovative. They offer the product at the right price. They become available and become affordable. And then they scale it up. I think those are the few ingredients which are important if you want to be right in the consumer space. And those are the names, therefore, what we own in our portfolios.
Rajesh, even though the overarching narrative on IT was weak demand, weak macros, cut in discretionary spending, project cancellations, many mid-cap IT companies did phenomenally well last year. Cyient is up 173% in the last 1 year. Birlasoft is up 145%. Even a company like Persistent has seen an 80% growth. So if you pick the right stock in the IT space, you would have done very well. Do you own anything in the IT universe?
But yeah, we do own few names within the IT. So kindly please put a disclaimer, because now we are talking about the stock specific. The companies what we are talking, we might be holding for our PMS clients or in individual capacity. So we own, for example, Birlasoft, we own Coforge, we own Tata Technologies. So these are the few names in the mid and small cap space, what we own. By the way, these are now no more small companies. If you look at their profit size of these companies, they are probably moving from 200 to 500 to now 800 crores over the next 2-3 years. So they are no more small companies, although they get classified as a mid and small cap. So I think you need to be, as you rightly said, you need to be stock specific. You need to do your bottom up work, because electrification and the EV related programs are continuing. And companies like, for example, KPIT is the best position, irrespective of what happens to the global economy, the recession or inflation or interest rates. And same thing is for other two companies which we are holding, because they are changing their product portfolio to become more relevant, and then they are gaining more market share. Their legacy portfolio is much smaller, which is under pressure compared to the large IT names, where the legacy portfolio is huge. So while they are doing well in their new offerings, the old portfolio, the product portfolio, the legacy portfolio on the services side, that is not growing. And therefore, you see the overall compression in their overall growth. So that's how we are playing the IT sector.
Rajesh, you mean the other thing is sort of Capex related themes which you've liked for a while, right?
Yeah.
Anything new you've done there? Anything you've topped up on?
Yeah, we continue to like the Capex related theme, and we keep changing within that depending upon the valuation parameter. So we keep adding to our favorite names like Hitachi Energy. We continue to like this name. We own it from last, I would say, close to probably more than 1.5 to 2 years. We continue to like this name, and likewise. So we own basically here the companies which are product as a portfolio, and that's very important. So they are not typical EPC player, kind of a thekedari ka work. They are not like that. They have a real R&D, they have a real innovation, they have a technology as a moat, and they are the biggest beneficiary of smart grid. They are the biggest beneficiary of capacities which are coming up in data center, which is going to become 2x or 3x over the next 3 to 4 years. And they are biggest beneficiary of the overall process automation. So these are the companies what we own. They are the largest beneficiary, and they also have exports as an additional opportunity. So your domestic economy is going to revive, particularly on the transformer side, on the data center side. And then you have a Europe plus one as an opportunity for select few players. So that's how there's a one portfolio what we are playing. The other portfolio what we are playing is through the companies which are into compressors. So for example, if you look at Kirloskar Pneumatic, that's one company what we own. They are into compressor. And again, domestic and exports, they both combined can give the good growth for this kind of a company. So these are the few names what we own in the Capex side of the business.
Rajesh, just getting back to that point about KPIT Tech, since that's a company that you own in one of your portfolios, with your PMS clients, you've clearly studied the entire space. What is your read of Tata Technology? It had a great listing. Issue price was 500. On day one, it doubled. Immediately, it went to a high of 1400. But after that, the stock has been languishing and has actually come down from a peak level of 1400 down to about 1160. Just pull up a 3-month chart of Tata Tech, for our viewers, and then they would see what I'm talking about. At what point, how would you compare Tata Tech versus KPIT Tech, and at what point does Tata Tech become attractive?
Well, I think it's probably the best company to own, if you ask my frank opinion, within the entire space, because they are the best of the management, best of the domain, best of the experience, best of the customers, best of the relationship, and last but not least, best of the execution. So while all these things are best, of course, in terms of the, what I would say, final earnings growth and then the valuation for their earnings growth, these are the two important parameters, am I right, when you buy any company. So that's where it is on our watch list. And at some point of time, we would love to own this company. It's a great company. And we are just waiting for probably some time correction, some price correction, and hopefully we'll be able to get at our target valuations, and that's the hope. So let's see, when it enters the portfolio. But definitely, yes, it's a great name to own for the long term. The only point is the valuations, where we are still not that comfortable, so to speak, for our main AAA IOP portfolio.
Okay, all right, Rajesh, we will leave today's conversation on that note. Good talking to you as always. Thank you very much for taking out the time. Thank you. Back to the screen for a bit, and we have a very feeble sort of an up move left now. 0.25 percentage point on the Nifty after the fall. I mean, we're kind of stabilizing, not a big rebound, but we're just sort of stabilizing now. The Bank Nifty is about 100 points away from its day low, and that's where the problem really was, and that's where the fall became most pronounced. So that's the way the situation is playing out. Let's quickly take a break on that note. We'll come back on the other side, and of course, we'll get you some more trades with Mitesh for the last half hour.
Welcome back. Well, no signs actually of any kind of big recovery, so I don't think we're going to get past the 21,600 odd mark. The Nifty Bank has slid down a little bit more, and the Nifty Financial Services Index as well. After the initial downtake, it's struggling to recover as well. Let's get in Mitesh Thakkar. Mitesh, well, you said you're looking to buy the dips, I think, on the Nifty. If that is still the case, then where does your stop loss come in at on the Nifty?
So Nigel, my spot buying zone is closer to about 21,520, 530, and keep a stop below 21,465. I think that's the way we'll approach it, believing that 21,500, 480 pivot will hold on to the support. And, we'll continue to trade in the range and keep going up. But in case the stop loss gets triggered, then I think 21,200 is a possibility which can happen on the downside. But that should be it. I'm still believing that this is more of a pullback come consolidation rather than a full-fledged correction.
Okay. In terms, anything specific you'd want to trade, Mitesh, stock-wise?
Prashant, I think, the stock of DLF has been showing good strength, and entire real estate pack is doing well. So DLF can be taken as a BTST with a stop at 783. Look for a target of 805, 810, possibly for tomorrow afternoon. And on the other side, on the sell side, I would want to have HDFC Bank as possibly, giving or completing this pullback to about levels of 1630. So sell here with a stop at, or estimate here with a stop at 1660.
Okay, all right, got that, Mitesh. Thank you very much. You have a good rest of the day, and we'll catch you with the market action tomorrow. For now, let's move to an exclusive conversation. Starbucks CEO Lakshman Narasimhan, in conversation with Shireen Bhan, has said that Starbucks is very excited about the India opportunity. The company is aiming to open 55,000 stores in the country over the next 5 years at the rate of 1 store opening every 3 days. Listen into the excerpts from this conversation.
From McKinsey to Pepsi to Reckitt and now Starbucks, Lakshman Narasimhan has seen a steaming rise to the top of an iconic American brand. Stepping into the shoes of the legendary Howard Schultz is daunting, but Narasimhan is taking each day cup by cup and store by store. Almost a year in, he's stirring up his strategy to make Starbucks even more global, doubling down on digitization and ensuring that the iconic coffee chain becomes much more of a lifestyle brand.
You've put together a triple shot strategy for Starbucks, which involves cost savings, but it also involves accelerating your expansion plans around the world. What are you prioritizing today? And as you look at this world, in your words, with limitless possibilities, what is the role that you see Starbucks playing?
So first of all, as I said, this is an iconic brand, and it's a brand that is founded on this idea of human connection. It is a brand that is founded on this idea that even in a polarized world, you have the ability to create a third place, a place where people can come and feel belonging, feel joy, and essentially advance the conversation forward. To that end, we said this triple shot in reinvention was about, first, it's about elevating the brand. Get the brand, take it even better. We've announced the Starbucks Arts Prize, which is a $1 million prize a year for an artist who's cutting edge into 38,000 stores, walls inside the store, walls outside. Elevate the brand. Innovation, products, huge amounts of potential there. The second is about us strengthening and scaling digital. We're a very digital business, and we have the potential to make it even bigger in what we do, how we connect with our customers, but also how we reimagine the factory in the back while delivering the theater in the front, the theater that you saw. The third thing we have is truly global, and this is where India comes in too. We have a big leg in the US. We've, of course, grown several stores in China. But the rest of the world has huge potential for us. Even in markets like Western Europe, we have headroom. You look at markets like India, we're just getting started. So we will be truly global. 3 out of 4 stores that we build over the next 5 years will be outside the US. Those 3 things are really important. And to that context, we need to obviously fund this. So efficiency helps us do it. It helps us build the capabilities that really reinforce this business. And the last thing, and perhaps the most important thing for me, is we have 460,000 partners around the world. These are partners hired locally. They're hired by, the local geographic partners that we have. Here we have an amazing joint venture with Tata's. These are people from the community that we're working with. So that's what triple shot reinvention is. And what it does is it gives us a comp growth of 5% in the long term, double-digit revenue growth, and earnings growth in the 15+% range. All that put together helps us create a financial result. But in so doing, we meet the needs of all the stakeholders. We have partners, customers, the farmers and coffee, the community, as well as the environment.
You can catch that entire conversation at 7 p.m. this evening and also at 9:30 p.m. only on CNBC-TV18. Okay, we do have to take a quick break, but when it comes to the market, obviously the next big event for us here in India is the Q3 earnings season. We caught up with Gautam Duggar today, Head of Research Institutional Equities at Motilal Oswal Financial Services, on some of his top sectoral bets and how he's looking at the market as we get into earnings season.
This quarter is going to be a bit lackluster, and given the fact that you have more furloughs this time, and the commentary which has come in, from the other companies too over the last 3-4 months, the expectations are really muted, Prashant. So much so that just statistically, this is the first quarter after 26 quarters where we are expecting a YOY decline in IT earnings. Auto volume numbers are already there; they have been disclosed. So, as far as the sector is concerned, from our model portfolio stance, we moderated our overweight there. We are largely equal weight now. Two-wheeler, obviously, there is clear positive shift in demand patterns over there, as we witnessed over the last 2 quarters.
Welcome back. Well, as we speak, the Sensex has moved into the red. The Nifty as well has dipped a little bit, and the Nifty Bank has taken a leg down, and now it's approaching that 47,000 odd mark. So let's get in Jay Bala from cashthechaos.com, who joins in on the show. Well, Jay, I wanted to view first up on the Nifty Bank. Let's keep the Nifty at the side because that's the one that's looking a little bit jittery. Just a few sessions ago, we were headed to around 49,000. We're back down to around close to around 47,000. How would you trade this index? Where does support lie, and what are the levels you're looking at?
Yeah, thanks, Nigel. Thanks for having me on the show. See, you've rightly taken the correct index over there, and it's probably registered a small head and shoulders top, and it's coming off from there. If the index were to drop below 46,920 and 46,888, I think the probability that Nifty Bank registered a major top would increase exponentially. So watch out for this. So there's a short play going on the index. The nearest supports I've mentioned, and below 46,888, it's about 46,500. So that is a short play going on in the Nifty Bank index. And I've been pointing out for several months now that Nifty Bank is going to be the problem pocket, and it's behaved quite expectedly. And the Nifty is still positive even now, but the banking index from plus 3/4% has come down to negative 0.5%.
Okay, Jay, hi, good afternoon. So it's been really one step forward, one back for the market. No sense of, directional clarity in the last couple of days at least. Let's talk about sort of, what you're seeing ahead for some of these IT names, on the charts, because that's the next event. TCS, Infosys, do you see any trades on these stocks at all? Or would you completely avoid them till the event is over, the fundamental earnings event?
No, if you are a short-term traders, would be there is definitely a trade out there, but it's definitely only for the extreme short-term that lasts about say 3 to 4 sessions, and not beyond that. The 36,100 that the Nifty IT index registered, it doesn't look like a complete move. Probably one last higher high is due. Everything from Infosys, TCS, look like they are going to make one high past the December high it registered. So the best out of that is probably HCL Tech probably heading towards 1,600, and a stop at about 14.15 would make a lot of sense. But as I said, it's an extreme short-term trade. If you want to pick up other IT names too, something like a stop below the 4th of January, 3rd of January low that the market registered for each of these IT stocks, that will be the stop. And we are looking at a swing high past the December highs.
Okay, I got that. By the way, Ajay, does your views kind of, are they in sync with what you're seeing out there in global indices, etc. as well? The 10-year back at about 4%, around 4 actually, as of yesterday's close. Or these are largely independent. I'm saying independent because, the Indian market has been in a different league in terms of outperformance. Really. So it's really been unaffected by everything which has been happening in the world. So just your thoughts there.
Yeah, it may not be reacting in a lockstep fashion, but definitely it's going to bear an impact. The US 10-year yields is extremely important, and my view that for the 24 months time frame or slightly over that, the US 10-year yields are heading for 800 bips. And as I've been saying since the last week of December, the next economic data is probably the last one that's going to be inflation friendly. In the sense, it's going to cooling. Like when I say inflation friendly, it means cooling of inflation. But beyond the next data, the CPI print is probably coming on the Thursday, and probably even that could be having an impact. And we're going to see hardening of the yields, and we're going to probably see about the 500 bips that we saw in 2023. We're going to see a cross of that in 2024, probably right in the middle of the year. And the dollar index is already showing signs it could have reversed. Watch the euro. If it were to print 1.103, 1.104, and then reverse from there, we're going to have a risk-off event. So that's, combine that with the US 10-year yields. If the US 10-year yields were to cross 440 bips, we already have a bottom in place, and we're going to have a very sharp rise in the US 10-year yields.
So 8, are you still holding on to that? So we'll at some point we'll cross 5 and then go to 8, the US 10-year. That's your view.
Absolutely, there's it's very close to being cast in stone, but because nothing is sure in the market, everything is probabilistic. There is no change in my view that from by 2025-26, maybe even shorter. But I'm just being conservative. we're going to see very sharp rise in US 10-year yields, and concomitantly, we're going to see the rest of the world shadow the US 10-year yields, and they're also going to raise the rates. And inflation is probably, the message from the market is that inflation hasn't cooled off. It's probably going to come back with even more vigor, and probably Fed is going to pedal back when it comes to cutting rates.
Hey, well, Jay, that's not the base case narrative, even the worst case narrative that most market participants are working with. Everyone's, looking forward to this nice Goldilocks year with, rates moving down, etc. But anyway, you mentioned the 10-year yield. On the equity side, or, even any other asset classes, is there anything else that's corroborating that view where you're seeing the charts flash red? US 10-year yield is one. But on stocks, for instance, these magnificent 7 US tech stocks, again, they rallied last night. Are you seeing any other indicators on any of the equity names which kind of point to some danger as well?
Yeah, a good point there should be, we have divergent signals from there. The stocks and the US S&P, they are pointing that they might have already turned. But, we don't have that confirmation from the Dow Jones Industrial Index. So, we are still waiting for further confirmation. But, copper is looking slightly shaky. And if a copper were to drop below 3.72, there is a 25% drop coming for copper. But my view is that, as I said last week or 2 weeks ago, one final high is probably due for copper, but that's a corrective rise. It's probably going to push past 4.02 and change. But, if that doesn't happen and copper breaks 3.72 straight away, I think the top is already in. So there is another signal coming from there. The Russell 2000, the broader market, once again, there is also pointing to a trend shift. But as I said earlier, the Dow Jones Blue Chip Index hasn't given the confirmation yet. It's still saying that it's probably got higher highs to come through.
Jay, any quick thoughts on these consumption, the FMCG names, which have been under pressure over the last 2 days? Fundamentally, the business updates have not been great, but technically, what are the charts telling you?
Yeah, I think FMCG names are going to be at least temporarily a strong pocket. My belief is that it's still got one more higher high to come through, probably closer to 60,000. And it may not be led by ITC. It could probably be led by Britannia and Nestle. They are the stronger ones at this point of time, but it still looks like an unfinished move for me. So probably expecting 60,000 to get registered, led by Britannia and Nestle. And I expect that to, be the probability of a top could be there, but we'll watch as the markets unravel. But right now, it looks like an unfinished move. So Nestle and Britannia with higher highs.
Okay, all right. Jay, we'll leave it there. Thank you very much for joining us here on this edition of Closing Bell here on CNBC-TV18. Appreciate it very much. Thanks for your time. Well, the markets pulled back. The Nifty, I don't think went into the negative, went into the red, although it went very close to being in the red, about 6 or 8 points on the day, and then came up a little bit. So 40 points higher on the Nifty. We're at about 21,553. The bank's index has been the weaker of the two, 0.5% lower, 47,230. Mid caps and small caps absolutely flat in trade today. Just a quick look at sectors which were under pressure. Media, of course, largely because of what was happening with Zee. Apart from that, banks, I think we already mentioned, not very much. FMCG maybe 0.25%, and oil and gas, nothing actually. It's just banks, both private and public, and FMCG, the 2 or 3 sectors which were down as a whole. Otherwise, most sectors were up and about. Not anything large, but still in the green. So it's a subdued close after what was a very promising start in the morning. Prima.
Okay, let's run you through some of the big drags today. Consumption was under pressure. So the top Nifty loser today was Britannia with a fall of 1.2%. Nestle lower by 1%. Asian Paints too under pressure. Banks sold off, particularly in the last 1 hour. The biggest loser in the banking universe was HDFC Bank, down 0.7%. ICICI Axis also ending in the red. The gainers list was topped by Hero MotoCorp, and Bajaj Auto too did well after that buyback announcement.
Well, on the mid-cap side, the gains really came off, and you've got the mid-cap index ending with an up move of just about 60 points. However, the advanced decline ratio was quite positive. Unlike yesterday, you still had far more advancing stocks than declining stocks. I'll just name some of them. DLF had another great session, 4% up on DLF. Today, some of the capital good names did very well. Siemens and ABB up between 3.5%, 4%. JSW Energy from the industrial space up about 7%, actually 9% on JSW Energy as we're closing out. Another good day for Godrej Properties, 3.5% up here. Some of the financials like Poonawalla Finance did well. These were the gainers. By the way, good day for Nykaa, 5.5% up on Nykaa. However, having said all of this, let's talk about some of the declining stocks as well. Zee for sure, Zee with the uncertainty continuing on the fate of the deal, though the company is, of course, denied the reports that were suggesting that the Sony deal is off, but still the stock is ending lower, almost 8% down. You had some selling on a REC, on an RBL Bank, on Indus Towers, and some of the other financials like L&T Finance and Central Bank of India. So basically, some of these financials where the volumes are usually high, today they were high on the lower side. But overall, bulls will say this goes down as a disappointing session because you go back to tracking the lows of last week, which is the 21,500 zone. Nifty ending with a gain of just 40 points for the day, with the fall in the banking pack once again. Well, with that, we are out of time on this edition of Closing Bell. Many thanks for being with us. Take a quick break, but don't go anywhere because Markets Forward comes up next.